In this video we are going to focus on how the first in first out and weighted average methods affect the outcome in the financial statement. As you have may notice from the previous examples, when using the first in first method or the weighted average method, different values will be determined for each of the following. The cost of sales will differ between the two methods. The gross profit will differ, as well as the closing stock. The effect of these differences on the financial statements is summarized in the following table. So when it comes to cost of sales, the value that we got for the first in first method was 21,500, whereas for the weighted average method we obtained 23,806 rand and 45 cents. So what is the effect on the income statement? In the first in first out method, we notice that the cost of sales will have a lower value than in the weighted average method. So that will mean also that the gross profit will have a higher value. So we make more gross profit. When we look at the weighted average method, it is obviously the opposite case. The cost of sales will now have a higher value, therefore the gross profit will have a lower value. So in fact, the gross profit value from the previous example for the first in first out method is 27,100, whereas in the weighted average it's 24,793.55. So this confirms what we just said, that the gross profit is higher in the first in first out method than in the weighted average method. The effect on the income statement is therefore, as we already mentioned, that the gross profit has a higher value, and therefore also the net profit, the bottom line, will be a higher value, and therefore we will pay more tax. When we look at the weighted average method, we already indicated that the gross profit has a lower value, 24,793 versus 27,100, and therefore the net profit will also be lower. And if we have a net profit that's lower, we will therefore pay less tax. So when we look at the closing stock, the value from the previous example for first in first out was 19,500, and then for the weighted average method the closing stock value was 17,194.55 cents. So you see the value of the closing stock is higher for the first in first out method. So inventory amount is higher, and therefore our current assets value will be higher, because inventory we know form part of our current assets, which has a positive effect on our current ratio, as well as our net asset value calculation, since our assets will be higher, since our current assets are higher. For the weighted average method, the inventory amount is lower, as we have already indicated. Therefore, the current asset value will be lower, which will have a negative effect on the current ratio, as our current assets are less, and also our total assets will be less. So it has also a negative effect on the net asset value calculation. So once again, we see here the whole concept that for everything you pay a price. So the advantage in the first out method is you pay less tax. The disadvantage, however, is that your current ratio and your net asset value calculation is worse. Whereas in the weighted average method, it's an advantage that your net asset value and your current ratio is better, but the price you pay is that So actually you have a negative effect on the net asset value calculation, and that's the disadvantage. The advantage is that you will pay less tax. So in both you have what's the advantage in the one is a disadvantage in the other one, and vice versa. So let's focus now on the weighted average method and the perpetual stock system. The weighted average method of stock valuation can also apply to a business using the perpetual stock system of stock control. When using the perpetual stock system, a new weighted average cost is calculated each time new stock is purchased. The same formula applies, namely that the weighted average cost is the total value of units available to be sold divided by the number of units available to be sold. So if we look at the example of the weighted average and the perpetual system, inventory system, we have the Sunglasses Hut sells various brands of sunglasses. They use the weighted average method of stock valuation and the perpetual stock system. So now we have the transactions relating to Oakband sunglasses for February 2014. On the first, we had stock on hand, our opening stock, 200 sunglasses at 320 Rand. On the 4th, we purchased 100 sunglasses at 340 Rand. On the 10th, we sell 210 sunglasses at the selling price of 500 each. On the 18th, we purchased 300 sunglasses for 312. And then on the 23rd, we sold 136 sunglasses again at the selling price of 500 Rand. We first have to calculate the value of the closing stock at the end of the period. Then we have to calculate also the cost of sales value, the sales amount, the gross profit, and if the business uses the periodic stock system, we also have to work out the gross profit. So first let's calculate the value of the closing stock at the end of the period. So we had on the first stock on hand of 200 units at a cost price of 320 Rand. So then we also purchases on the 4th 100 units at 340 Rand. So at this point we can calculate the weighted average cost. So on hand after the purchase we have 300 units, and the weighted average cost will simply be the 200 units times the 320 Rand plus the 100 units times the 340 to get the total value of what's available to be sold. We have to divide by what the number of units available to be sold, and we will get a weighted average of 326.67, which makes sense. It's between 320 and 340, and since we had more units at the lower price, it's a bit closer to 320 than 340 because we know 330 would be the mid price. So that's now our new cost per unit. Then on the 10th we sold 210 units. So the cost price of those will be the 326.67 as it is at that stage the weighted average cost. So our cost of sales is therefore simply the 210 units times the weighted average of 326.67, which result in 68,670. So now after our sales we can get our new number of units. So we had on hand 300, we sold 210, we should have 90. And the cost per unit is still 326.67. That's the weighted average cost. Then on the 18th we purchased 300. This is now at a new price, 312 Rand. We can multiply the 300 by the 312 To get that value, let's just first get the number of units. We had 90, now we purchased 300, so we have 390. We have the 90 units at the previous average price of 326.67, so we multiply the 90 by the 32667, and then we have to multiply the new 300 by the new price of 312 to get the total value of stock available to be sold. We divide by the number of units, which is now the 390. We get a new weighted average price of 315 Rand 39, which we see is now less than the previous weighted average, as the new bunch of items were purchased at a lower price. Then on the 23rd, we had sold 136 units. We sell it now at our new weighted average cost. So the cost of that sales will be the 136 units at the new weighted average price of 315.39, which result in 42,893 Rand and 4 cents. So now we have on hand the 390 minus the 136, which is 254 units at the 315 Rand 39 cents. So now we can determine the value of our closing stock. It's simply the 254 units times the 315.39, which will result in 80,109 Rand and 6 cents. The cost of sales, we are also in a position to calculate. So it is the 68,670 plus the 42,893.04, which results in 111,493 Rand and 74 cents. So now we can determine our sales. So we have the 210 plus the 136 units. We know our selling price is 500 Rand a unit. So if we multiply that, we will obtain 173,000 Rand. So the gross profit, we know sales minus cost of sales, the 173,000 minus the 111,493, which results in 61,506 Rand and 26 cents. The weighted average and the perpetual inventory system. Let's do the final part, the calculation of the gross profit using the periodic stock system. So we know, according to the periodic stock system, the total value of units to be sold is our opening stock plus the purchases. So we had the 200 units at 320 plus that was the opening stock, plus then we obtained the 100 units at 340, that's part of our purchases, plus another 300 units purchased at 312 Rand to obtain the 191,600. The number of units available to sold was the opening stock of 200 plus the 100 that we purchased in the beginning plus the 300 that we purchased later on, which is 600 units. So the weighted average cost per unit is now the total value of the units available to be sold, 191,600, divided by the number of units to be sold of 600, and we obtain the 319 Rand 33 cents. Value of the closing stock. The previous slide we determined there were 254 units. We multiply now by the weighted average cost of 319 Rand 33 to obtain 81,109.82. So the gross profit using the periodic stock system, we have the sales, as shown in the previous slide, the 346 units sold times the 500 Rand results in 173,000. Then cost of sales, we know, is the opening stock plus purchases plus tax, the import tax if there are any, minus the closing stock. So now the opening stock, we had the 200 units of 320 Rand each, which is 64,000. The purchases, we had the 100 at 340 Rand and the 300 units at 312 for the 127,600. We didn't have any import tax in this situation, so we ignore. But we had the closing stock of 254 times the 319.33, which we have to subtract, because remember it's on the credit side of our trading account. So we subtract the 81,109, and so 64,000 plus 127,600 minus the 81,109.82 will give the cost of sales, which we now have to subtract from sales to result in a gross profit of 62,509 Rand 82 cents. So let's compare the stock valuation methods for each of the stock systems. The following table uses information from the previous example to show the different values that will be obtained using each of the stock valuation methods for each of the stock systems. Remember, the stock systems are the periodic and the perpetual. The valuation methods are the specific identification, first in, first out, and the weighted average. But here we are focusing only on first in, first out and the weighted average. So the sales we can see for first in, first out, for the perpetual it was 173. For the weighted average according to perpetual it was also 173. First in, first out, periodic and weighted average the same amount. So sales is not affected by any of this, because we know when it comes to the valuation it affects cost of sales and the closing stock. So let's therefore look at cost of sales. First in, first out, no matter whether it's perpetual or periodic, we got the same value of 112,352. But the cost of sales for the weighted average for the perpetual is 110,490 and for the periodic 111,493.74. So in the cost of sales differ between the perpetual and the periodic if the weighted average method is used. It was the same for the first in, first out. But we also see the weighted average, the cost of sales, no matter which method was used, was lower than in the first in, first out system, or method rather. The gross profit for first in, first out was the same no matter if it's the periodic or the perpetual system, whereas for the weighted average it differed, but what we also see is, though it differed, both were higher than for the first in, first out method. The closing stock, the first in, first out, whether it was perpetual or periodic, was the same, whereas weighted average, it actually differed between the perpetual and the periodic, but they were both higher than in the first in, first out method. We can see for the first in, first out method, it doesn't matter whether it's the perpetual, periodic, or the figures were the same, whereas for the weighted average, they were all different if considering whether it was perpetual or periodic. As mentioned previously, when applying the different stock valuation methods, different values are obtained for cost of sales and closing stock, as mentioned previously. The cost of sales amount then directly affects the gross profit amount. You will notice that the first in, first out method yields the same results for both perpetual and periodic stock systems. However, these results will normally differ for each of the stock systems when the weighted average method is applied. Although this wasn't the case in the previous example, it can generally be assumed that the price at which stock is purchased will increase over time. We know it's due to the effect of inflation. Therefore, the first in, first out method will normally yield lower cost of sales amounts and higher closing stock amounts when compared to the values obtained using the weighted average method. The reverse could be true if the prices over time in fact reduce and you have deflation. In general, these differences will be less noticeable if the weighted average method is being applied by a business that uses the perpetual stock system.